Hey guys, and welcome to another episode where we talk about different trading strategies. We look at what's happening in the markets, and we really just gear towards educating you and helping you along your investment journey. So, in today's show, we're actually going to be talking about swing trading. We're going to look at what swing trading is, why some persons do swing trading, and also how swing trading can benefit you. Alright, so swing trading really is just investing in the markets in anticipation of a price movement and really how it can benefit you. So, swing trading can last anywhere from a couple of days to several months. So, in essence, to really break it down, swing trading is just riding the wave. Whether you're gonna invest low and just ride it out until it goes all the way up to its highest peak, or you're gonna invest when it's high and it falls, so you're shorting it. So swing trading is really one of those trading strategies that a lot of persons on Wall Street, a lot of corporates, they use usually when the market has recovered or is recovering. And so the reason for this is that while the market is in the depressed state or the bear market state, it tends to really just move within a certain price point, and so it doesn't really move outside of that price point unless something major happens, whether positively or negatively for the company. So when the markets now recover, are starting to recover, and persons are anticipating more great things to actually happen in the markets, then that is when they would start using swing trading more because prices tend to move more. So whereas during a bear market or recession, the prices would move maybe between 5 and 10% for a period. When the market starts to recover or is in that recovery state, then you go from getting 5 to 10% to 20, 30, 40% over the same period, and that can be a couple of days, couple of weeks, couple of months. So why do some persons do swing trading? Well, it really is about riding the wave. So if you are anticipating really big things for a company, then you would want to get in early and invest early and just wait it out. So you usually purchase the stock at the quote unquote low price, and then you hold on to that stock. And if you're trading and you're buying it for it to increase, then you just purchase the stock and you just watch it increase and increase in price. And the minute that it starts showing signs that it's gonna start falling, then you'd sell it, and vice versa. So if you're shorting the stock, you would short it at the highest point, and the minute it starts falling, you just keep shorting it, and the moment it shows signs that it's gonna start recovering or picking up in prices, then you would reacquire or sell the stocks and reacquire your funds. So these are really the reasons why persons do swing trading, and it's one of those trading strategies that is on the riskier side. So it's more recommended that you have an aggressive appetite if you're actually gonna do swing trading. So if you're risk averse, you may prefer to stay away from swing trading and just focus on other trading strategies such as value investing or dollar cost averaging, those sorts of trading strategies. So how do you know when to do swing trading and when swing trading is great? So with swing trading, there are a few metrics that you look at. So it really involves a lot of technical analysis, and fundamental analysis is good to do for swing trading, but it is not really required. So unless you're really investing for value, or you're planning to invest in this company for a few months or longer, then the fundamentals would be great to have. And usually I always say it's good to do fundamentals before you invest in any stock. So calculate a few ratios. You don't have to go necessarily in depth in the analysis, but you can calculate a few ratios, such as a few of your liquidity, your profitability, your leverage, those sorts of ratios. So you just calculate one and two of each, and then you decide whether you want to swing trade a stock or not. So when it comes down to swing trading, now the two main metrics that persons look at, the first one would be the Bollinger Band. And so the Bollinger Band actually sets out into three main parts. So it has an upper limit, a lower limit, and a moving average in the middle. So what that really means is that the Bollinger Band moves in a particular direction. And so when the stocks are moving in that direction, it usually tells you what is happening in the markets in real time. So with the Bollinger Bands now, if the stock is trading at the upper limit, then it usually means that the stock is overbought. So what that means is that persons tend to pay a lot more for the stock than it really was worth. And that's one of the downsides to it. And likewise, if it's trading towards the lower limit, that's the lower level of the Bollinger Bands, then the stock would be considered oversold. And so what that means is would be a great buying opportunity. So when it comes down to using the Bollinger Band, you want to keep hold of the stock when it's in that middle range, so when it's in that moving average. So you don't want to hold on when it's at the upper limit, and you don't want to be selling when it's at the lower limit. So at the lower limit, that's when you want to start purchasing units, and when it's at the upper limit, that's when you start to sell these units. And so the great thing with the Bollinger Bands is that once you can identify the peaks and the troughs, then that's really all that you need to know. So how the swing trading operates is that it goes up and down. And so what you want to do is you purchase the stock at the bottom part. It moves, and the minute that the Bollinger Band starts to shift direction, so if it's going up and it starts to reach that curve and it's about to start falling, that's when you get out. So at that curve part, so at the top, that's when you start to sell out. And likewise, if you're shorting, you want to purchase it at the top, and the minute it goes into the trough and it starts to go into that recovery state, that's when you want to start getting rid of the unit. So you sell them off and start purchasing back your money. So that's really it when it comes down to the Bollinger Bands. Now, the other one strategy that you want to look at is your moving day averages. So you look at your 15-day and your 30-day moving averages, and this really just gives you this real-time data as to what's happening in the market. And it's very similar to the Bollinger Band. The only difference is that with the Bollinger Band, it has three layers. So there's an upper limit, the moving average, and the lower limit, while the moving average is just two layers. Or if you want, you can put in a third moving average, like a 125-day moving average, but it's not really required. 15 and 30 days should be good. And what that tells you is just, it shows you the price movements over the 15 and 30 days. And so similar as how you'd approach the Bollinger Band, you invest when it's low at the bottom period in the recovery state. You hold on to it while it's being recovered, and the minute it reaches that peak state, that's when you start to sell out of the stock. And similarly, if you're short in the market, then you want to actually sell the stocks at the high price, and then you purchase it back during that recovery period. So at after the trough, right before the recovery. That's when you want to start purchasing us back your monies. Essentially, selling the stocks or purchasing back the stocks, so getting back your money. So that's really it for the moving day average. And so these techniques and strategies are used a lot by forex traders and, as stated before, persons on Wall Street and corporates. But the reason why it's used in forex trading is that when you're comparing currencies, you tend to want to understand the movement of the currencies, and likewise with trading stocks with currencies, you want to know exactly what's happening in the market. So you tend to look a lot at the political scene and really what is being done in the market and just how investors are viewing the market. So right now with the new president-elect of the United States, the US dollar has actually started strengthening against their peers. So what that means is if you are trading forex, you don't want to be purchasing more US dollars or shorting the other currencies against the US dollar so as to really make the most out of your money. So that's really it when it comes down to swing trading. So swing trading really is just riding the wave. So you want to purchase the stock or short the stock and you hold on to it for as long as you can. So you hold on until it reaches that peak or that trough, and then you get rid of it and you collect your money right before it changes direction. And so when you're swing trading, you want to use technical analysis such as your Bollinger Bands, and your moving day averages 15 and 30 day 125 can be used, but it's not really necessary. And you want to really just get in at the best opportune time, and that would be at the low period, and then you get out at the high period. Swing trading can last anywhere from a few days or weeks to as much as a few months. So when you're swing trading, just know that, like with stocks investing, you have to pick your period when you want to enter and exit. So if your goal is to get in and out of the stock as quickly as possible, then maybe you'd want to set your time periods for 1 month, or if you have a little bit more time, maybe 3 months or 6 months. But if you have a long time, then you can set it for about 6 months. And so what this really does is that if you're swing trading and your time frame is 1 month, then you know that the minute the stock starts to switch direction over that short period, you get rid of it. But like with stock trading, the market tends to shift over time, and the longer that you hold on to the stock, it's usually expected that it's the flatter or the more predictable you are in terms of the direction of the stock price. And so if you're investing for several months, then you would know that short-term dips is possible and would be fine in the market, because your goal is not to sell out the minute the stock drops by a little bit, but it's really to hold on to it for and to get as much value out of the stock as you can before selling it. And so the time frame really adds a lot to investing and how you go about the type of investing, so the swing trade. So that really is it for swing trading. So I hope you guys liked this episode. If you did, ask you just to give us a thumbs up, leave any comments you may have down below, and share this video with a friend who you think might benefit from this information and subscribe or follow us wherever you consume this material so that you do not miss out on any new episodes as soon as they are launched. Alright, until next time, take care. Love you guys. Always. Hey.